Good morning, everyone. I just wanted to check and make sure you can hear me before I get ready to start.
Good morning, Mona. I can hear you.
Thank you, Michael.
You're welcome.
I will let you see my face until I get started. Smile at everyone.
How you doing? I'm on
Good.
camera too. Wearing my
Good.
turnkey shirt. Now I'm going in back
I
to the
don't have a
picture.
turnkey shirt. I want a pink one.
Good. Let marketing know that. Let's see here. I'm going to turn this here. Well, we're excited to have you today. Present.
Thank you.
Great topics.
Can you see my screen? I've
I,
shared it, but
I
I
can
don't know
see
if
the
you can.
session 2, inventory utilities and management relevant to supply chain issues and volatile economies.
That's correct.
We're good.
Okay. So I will go ahead and get started. I think everyone that will join us for 10:30 is probably here, but I'm going to be talking about inventory utilities in GP. And the reason that we're having this conversation today is because of the current economy and what we're all experiencing. We did a lot of maintenance early in the year for our customers with regard to HITB, reconciliation, standard cost updates, and that sort of thing. And then with all of the spiraling costs, we have a lot of customers that are experiencing a lot of pain trying to manage their costs. And we'll talk about price utilities that you can use to control based on what your costs are, what your cost changes are. And we'll talk about inventory planning that I think a lot of people may not be utilizing, but can be useful for you with all of the supply chain issues that we've been experiencing since COVID and continue to experience. And I will go in that order. We'll talk about valuation methods, cost maintenance, inventory planning, and then we'll end with inventory reconciliation. For those of you that have not worked with me, I am Mona Goodwin. I've been a GP consultant for 27 years. I started working with GP while I was actually still in college as a student, helping one of my professors and working for a partner at the time. Great Plains was still Great Plains out of Fargo. It was before Microsoft came along. And I guess about 20 years ago, I really started focusing on supply chain distribution and manufacturing. And I just find it very interesting. I like all of the different companies I get to work with. And I really like trying to put together all of the pieces. I really like the process um, aspect of supply chain and manufacturing. So I get pretty impassioned by it. And those are the types of support cases I tend to um, lean toward or favor. So I'll get started with the presentation now. I'm going to turn off my camera so everybody can focus on the slideshow. Um, as I had already mentioned, we'll talk about the inventory valuation methods. I want to talk to you about the periodic as well as the perpetual valuation methods that GP allows you to set up and what each one of those mean to your business. And then we'll talk about where those are stored, how they're maintained for different types of business and at different times of the year. I'll talk about inventory planning, and that will be impactful for your supply chain. We'll talk about item resource planning using the PO generator and tracking vendor information specific to your items. And then we'll wrap it up with inventory reconciliation, the difference between the HSS and the HITB, which we have a lot of people using the different reports, and I think it's important for you to understand what and how each of those reports work and what they're each intended for. And I'll talk about reconciliation to the general ledger some tools in GP that would help you with that reconciliation. So starting with GP, the cost valuation methods, when you set up an item card, there are perpetual and periodic, and there's average perpetual, but I'm going to be focusing on perpetual and periodic. The perpetual is your current cost methodology, and if is the actual cost of an item the last time that an item had any type of receiving transaction. A receiving transaction would be a purchase receipt. It could be a receipt that comes in from a manufacturing process. It can be transferred from another site, or it can be an item transaction where you've adjusted up your inventory values. And the cost value, when it is sold or transferred, is taken from the cost layers based on whether or not you're using LIFO or FIFO. We'll talk about those cost layers in some of the following slides. And I'll demonstrate for you that the cost that's displayed on a transaction is not necessarily the cost that will be used at the time you post a transaction. And I'll show you where you can get the cost from, where you can view those layers so that you'll understand what the impact will be. And also that might help you in doing quotes for customers. So the first thing we'll cover will be a thorough review of the perpetual or current cost valuation method. And then we'll talk about periodic. Periodic is your standard or static cost. It's usually used in a manufacturing environment. I'll be talking about that from an inventory maintenance perspective. Manufacturing is really a large, uh, a much larger discussion, and we wouldn't have time to cover that. I'll touch on a little bit of how manufacturing is affected by the periodic or the standard cost, but mostly I'll be talking about the items and the cost maintenance themselves and the cost that's used and posted to your general ledger when you do those receiving and or consumption transactions. The average perpetual is a cost that is totaled, and an average is recalculated and assigned to an item every time a transaction is perpetuated. And I'm not going to focus a lot on the average perpetual just because the very large majority of customers are using perpetual or periodic. And if you have any questions specific to average perpetual, if you want to post those, they'll get those questions to me and I will circle back to you and have an individual discussion with you. So item cost maintenance for current cost items, when you've set up an item in the item card to use either perpetual FIFO or perpetual LIFO, then thereafter, any transactions that cause the inventory to be adjusted upward in your system will use the cost will go into a cost layer based on the cost that is at the transaction level. And an example of that would be a purchase receipt. So if you've done a purchase order and you receive that transaction in, the cost that you receive it in when you do the receipt is going to be the cost that gets posted in the cost layer for that item. And for inventory transactions, that's another type of receiving transaction. Either you're doing an inventory transaction to adjust an item in, or if you're doing an inventory transfer from site to site, because each one of those sites will track the FIFO and LIFO from one site to the next site and put it back into the appropriate layers. So any type of inventory transaction that brings inventory in, either into your inventory overall or into the inventory at a site level. Another type of receiving transaction, two other type of receiving transactions that we don't think about very much when they occur are manufacturing receipts. However, most manufacturing items, that's the, the cost is a combination of things, but whatever the cost is at the time that it's received, that's what would go into the current cost bucket. And another type of receipt that we don't think about much would be return transactions. So if you've got inventory returns coming either through a sales order processing module, when you're doing a return from a customer and you receive that item back in, then the actual cost of that item has traveled with that item. So if you're doing your returns appropriately through GP, then the current cost will stay with that item and you go back into the cost layers the way that it's supposed to, where it came from. And each time that you post a purchase receipt, an inventory transaction, or any of those other type of receiving transactions, whatever the cost is that you're going to see in the unit cost right there, it will go ahead and update your item card, and I'll talk about that in a minute, but it also puts it into a bucket. So if you think about your item cost as, putting layers into a bucket, so those costs will come in and they'll go to the next layer and they just start to build cost layers. And while this will go ahead and automatically update the current cost that shows up on your item card, we'll talk about later, that's not necessarily the cost that you're going to see when you do a sales transaction or any other type of consumption transactions. A consumption transaction is going to be the exact opposite of all of those receiving transactions. So you've got sales orders, and when those are transferred to invoices in at the sales order level, the item is allocated, and then when you actually transfer that sales order to an invoice and post the invoice, then the inventory is depleted. Other types of depletion transactions are going to be inventory transactions where you adjust an item down, or when you do a transfer from one site to the other site, it's a decrease in inventory at one site level, or when you consume inventory for a manufacturing process. So if you're consuming raw materials for a manufacturing process, all of those will consume the inventory, and based on how you've set up your item, they will consume it at current cost, but not necessarily the current cost that you see on your item card. Remember, that field is updated the last time you did a receipt, and based on if you're using FIFO or LIFO, and when you post the transaction, you may or may not see the same current cost show up as the unit cost on your consumption transaction. So what I've got in front of you is a sales transaction for a FIFO perpetual item, and you see that the current cost is $168. That was the last time I received the item. But because I'm doing FIFO, which is going to be first in, first out, my sales transaction, when I go to consume it, is going to go to the very bottom of my cost layers and look for the next available cost and items available. And that's going to be the unit cost that it's going to present to me in my invoice. Now, another tricky thing that some people run into, and I get a lot of questions about, are at the time that the invoice is created but is not yet posted, I see $152.10 in my unit cost field. However, if I wait a week to post my transaction, that may not be the cost that actually posts to my general ledger. And the reason is it doesn't actually calculate that cost until you physically post it. And that's because batches get created ahead of time and they may or may not get posted immediately. And that inventory is allocated but not consumed. And it consumes from the bottom of the cost layers. So it looks for the appropriate cost layer at the time it's posted to make sure that that's the cost layer that's available. If you have any questions about that or need a little more, you need more of a walkthrough on that in your system, then again, you can contact me at the end of the presentation and I'll schedule time to walk through that. When you have questions about the cost layers, if you're using FIFO or LIFO and you want to understand what the cost is that will be consumed prior to you posting it, GP does have an inquiry, and most people aren't aware that it's there, but there is an inquiry in GP where you can go and look at your cost layers. And you'll find it under the inventory inquiries, and it's a purchase receipts inquiry. It's the second one on the menu. And if you pull that up for your item, you'll be able to look at all of the cost layers, and you can sort those based on date or look at the cost layers within a given date. And you can see here that you can look at each line and look at each receipt, and you can follow it all the way down until you get to the next available cost layer. And that will be the cost layer that doesn't have anything sold. And if you want to look at any of those receipts, then you're able to drill down, obviously, into the little hyperlink that you have there for the receipt number, the purchase order, or the quantity sold can tell you where you've sold it at. And that gives you some visibility as far as the cost layers. If you want to look at those, if you're doing a verbal quote for a customer and wanting to look to see that you're quoting correctly for profitability, then you can come in and do an inquiry on your uh, purchase receipts cost layers and look at what's going to be up next for consumption. There are times that you look at the cost layers, and we did have support calls for this earlier in the year when everyone was doing a lot of reconciliation and year-end closing. And if you look at your receipt layers or you're doing any inventory reconciliation and you realize that you have an incorrect receiving cost for whatever reason, then there is a utility in inventory to adjust those inventory costs. And that is obviously something that you want to keep tight security on, but you would simply go into the utility for adjusting inventory costs, look for the appropriate layer, and you can find that by looking for the receiving date and the actual receipt number by expanding it, and you simply highlight the cost field and you update it. And it's important to do that through the inventory adjustment cost window versus doing it in any other of the SQL tables or doing it directly to the general ledger. And that it comes back to the reconciliation issues that we had earlier this year. When you bypass these proper channels and go directly to the SQL tables, then you may update that cost in the back end, but you're not going to get an adjustment to your balance sheet and you're going to have an issue with your GL reconciliation. By the same token, if you simply go and adjust your balance sheet, then you won't be able to reconcile the inventory subledger to your general ledger. But if you go ahead through the proper channels and use the inventory adjust costs window, then it will update your subledger, it will update your cost layers, and it will update your general ledger and your balance sheet. If you have any questions in using this, if you want to test it or play with it, and you have a test system you need refreshed, or if you need some information about doing this, just let me know. To my knowledge, there is not an integration that we can use to do these inventory adjust costs. In the cost layers, you can look around if anybody has a lot of items, but typically these are one or two transactions, and this would normally be the method that you would go through if you're using perpetual cost. So standard cost is actually much more difficult than current cost. And current cost, I feel like you have a lot of visibility to it. And what you're doing when you're posting that transaction is pretty straightforward. However, when you're using standard cost, which is typically for a manufacturing environment, then the maintenance of that standard cost becomes a bit more cumbersome, as does the visibility, and the reconciliation is also more difficult. And some of the reason behind that is that once you've created an item, and the first time you create the item, you can input the standard cost. So if I create this item for a 100 extra large green phone, I can bring in my standard cost at the time I create it, but once I've saved that record, I'm not able to come back and edit this cost through the inventory card window. And again, that makes a lot of sense because the inventory, when you start to receive inventory, and also consume inventory, then you've got a valuation of inventory on your general ledger, and you don't want to make those changes in the inventory card window because they will not update your cost layers, they will not update your general ledger, they will not update your balance sheet. So um, there are tools available to update standard costs, and again, this mostly affects people in manufacturing. There are tools available. So the first tool that you'll usually be directed to use is the inventory year end. And it it you need to understand how it works and what it does and does not do. And it does update from the current costs. So right now we're in an economy where costs are changing rapidly, and we find that customers who have used the standard costs historically for different reasons need to update those standard costs more frequently. Usually that is something that companies have done on a quarterly or an annual basis, and it's usually um, manufacturing items, raw materials. There's a reason that you would want standardized cost if you're doing manufacturing, but you often see that also in lumber or steel, oil and gas industries. You'll see a lot of standard cost usage. And but when we have inflationary periods like we're having right now, where the cost of building supplies, for example, the cost of raw materials, the cost of pretty much everything is changing very rapidly, in order to keep up, especially if your price is based on your cost, then you need to change those standard costs more frequently. GP offers the inventory year end as a tool, but as you can see, because standard cost is not intended to be changed as frequently, then it is a year end tool and it has its flaws. What the standard, what this cost update does is it looks at the item's current cost, because current cost is recorded. Even if you're using standard cost for GL purposes, the current cost is recorded. So this would go back and look at the most recent cost of an item, and it would reset the standard cost to whatever your current cost is. And that can work, but you need to be aware that it is for all items. So you don't get to pick and choose your items. If you run this, it runs across all of your items. So you would need to make sure that whatever is in that current cost field is what you want in the standard cost field across the board. And in that case, we could, because we're just using the current cost field, we're not actually trying to value inventory, we could run a SQL script to update your current cost to whatever you wanted for your items prior to you running this process. But you need to be aware that when you run this process, it does not create a journal entry to revalue the inventory on your balance sheet. You would need to run an HSS report and then manually create that general ledger entry. Um, so this is a method that is being used by companies. They will run this quarterly if they are updating more than once annually. And I can work with you to do test scenarios if you want to look at this to see if that's a means of updating your standard cost more frequently. The other means that GP gives you for updating your standard cost is to use this change item standard cost. And as you can see, it is one item at a time, and that is generally the issue that a lot of customers have, because there are quite a lot of GP customers using inventory that will have 10,000 or more items, and they may have all of those items set up to use standard cost, so doing one at a time is not viable. And using this would create the journal entries that you need, but the flaw is doing one item at a time. So, and again, we don't have an integration to do this for you. So we end up weighing the pros and cons of the two GP interfaces to determine what's the best method for you to update your standard cost on a frequent basis. If you're using manufacturing, most of you are already aware that what you would use is the standard cost roll up and revalue. Is absolutely always advised that you do that in a test environment first, because the impact to your general ledger is, with the complexity of manufacturing, it's really just not known until you run through the process. So if you're going to do a standard cost roll up or revalue and you have a certain volume of items, then we always advise you, please do that and test first. And we can also assist you with that. So the interesting thing that usually confuses most people in a standard cost environment, and I end up answering questions about this very frequently, are the standard cost, the current cost, and your purchase price variance. And it's a little bit tricky, and it sometimes varies per customer based on what you have set up, what you're receiving, how you're bringing items in, if you're doing those via an inventory adjustment, manufacturing, or through purchases receipts, and then how you've got your PPV accounts set up and where you're posting that to. But if you're using standard cost and you bring in do any type of purchasing or receiving transactions, and again, those can be purchase receipts, they can be inventory adjustments or transfers, or they can be manufacturing receipts. You bring that in at a standard cost. However, there is an actual cost that is still recorded and put into those cost layers. So the standard cost is what you're using to value your balance sheet, but the actual cost is still recorded. And the differences there are posted to those PPV accounts when you're doing purchasing or when you're doing consumption type transactions. And it's reconciling those PPV accounts that is usually frustrating. And you just need to understand how the current cost comes into the system, whether it's LIFO or FIFO, and which one of those will be used. And if you're using perpetual, are you using the perpetual LIFO or FIFO? What inventory valuations or revaluations you've done, and then looking at your purchase price variance per document. And it's usually requires a lot of effort to go in and reconcile those items when there is a question. The consumption for those standard cost items, again, occurs via sales, through inventory transactions, or through manufacturing when you create a manufacturing BOM. And again, the valuation at the general ledger for your balance sheet for your inventory is the standard cost. But if you're consuming it and it goes to look to see the difference between that standard cost and that current cost, then you may have a purchase price variance, or unrealized purchase price variances, depending on how you're posting and that type of thing. So I have had customers in the past who did not want that purchase price variance, but they did want the standard cost. And I've had lots of customers who would run a script that would keep the standard cost and that current cost the same. So they would want to update their current cost to be the same as their standard cost. So that would be one of those price utilities that we looked at earlier, so that they're not getting that purchase price variance. So I hope I'm not going too fast, but again, you can always come back to me and ask me these questions afterward if I've not been clear or if I've gone over a subject too quickly. But I want to make sure I've got time to cover everything. This is something I want to talk about in depth, which is the item price maintenance. So again, with the changes in the economy, when your costs are going up and you need subsequently for your customer costs to go up, right? So using the item price maintenance can actually protect your organization. If you're not using the price maintenance and you've got um, customer price lists, but you're not using GP to automatically maintain those, then you could be, operating at a loss versus profiting, right, with the rising cost. So the item price list, you're able to go in whether you're using current cost or whether you're using standard cost and do as a percentage of a markup of the cost or as a margin to that cost. Then it's up to you to determine which one. And then you're able to also select what the percentage of that markup or the percentage of that margin is. And you can also do price breaks. So if you're doing price breaks based on a quantity, then you can enter a layer in each of the price levels based on those price breaks. You can, did not mean to change slides, I apologize. You can enter those price levels based on each unit of measure that you sell at and or for type of customer. So you can have retail customers, which you may give a different price. Typically it's lower than what you have when you're doing B2C. And once you've set up all of those item price lists, you then can go over to the customers that you have set up in your system and specify which price level you use for that customer. So in this example here, Aaron Fitz Electrical is a retail customer, and so whether they're purchasing an each or a case and based on the quantities, then I have a certain percentage of markup for that customer. And then when I go to do a sales order, even if my current cost or my standard cost are changing, then what happens is that sales order is going to go back, look at the price layer, and look at what the next price layer is, calculate what the customer's price needs to be based on what my most recent cost changes are. And I feel like that maybe is a tool that a lot of people with price changes right now should be taking advantage of if they are not. The other side of the pain we're experiencing in the economy right now is supply chain. And everybody hears about the supply chain and the woes and worries that we have there. But you may be unaware that GP does have some item resource planning, and it is a tool that gets more mature and smarter as you use it more frequently. Excuse me. So the item resource planning is per item, and it can be per site. And you can determine that you have no order policy or that you have an order policy if you use the PO generator. You can determine what an order point quantity is and what your order up to levels are. So if you know that your supply chain is lengthening, then you might want to change your order point quantities or your order up to levels. You can enter your purchasing lead times, and then we've got some information that we collect as well on each vendor that becomes more mature as you use a vendor, and all of that information comes together in a purchase advisor and the purchase order generator. So the order point quantities um, are going to be when I reach a certain level of inventory on hand, I need to do a purchase order. And my order up to level tells me what I want to order up to. When I do my purchase order, it's going to look at what is my purchasing lead time, how much do I have on hand, how much do I have allocated, when are my allocations promised, and what outstanding purchase orders do I have? And it compiles all of that information to determine what do you need to do for a PO, right? And then I'll show that to you in just a few minutes, and you execute those purchase orders, and that helps you to keep some continuity so that you are not running out of supplies for your business. You can do the item resource planning by site. I just want to let you know that. So if you have locations in Louisiana, locations in New York, and each one of those has its own purchasing lead times, you got somewhere way out in Montana in the middle of nowhere, et cetera, that type of thing, you can set up all of your order policies for each one of those sites individually, and then do your purchase order generator based on site as well. This information is difficult to bring into GP. It's very time consuming. Normally, the easiest way for us to bring this in is to import it, and it's not too difficult if you have existing item numbers and you populate those columns across the board for each one of the items, the sites, and all of your order point quantities and what you believe your purchasing lead times are. We can actually bring that into GP for you pretty quickly through an integration versus having end users try to manually input this because it's a lot of screens to drill back to populate. On the vendor record, um, most of you who are using inventory, I usually go in and I look at your inventory and I'll see that you do have vendor items assigned and you have vendor item descriptions assigned, things like that. But I don't normally see any of these minimum, maximum economic order points, that type of thing populated. So I don't believe very many people are using this, but there's a lot of information on this screen that's really, really useful for the PO generator and for your your supply planning. You can go in here and put in what are the minimum quantities, the maximums. that you purchased from a specific vendor, and then the economic order point. So if you've got a vendor who's giving you, uh, price, you know, benefit for ordering economic amounts, then you can do that. And then you can also order the multiples if you order by 10s, 20s, 50s, that type of thing. And that really helps to facilitate when the purchase order generator comes up and it's saying, okay, you've got 400 and you need 1,000, but there's an economic order point of this many, right? So you start to pull all that information together to make your best estimation of what you should be purchasing. This information per item per vendor. And once you've the way this matures for you, however, is that when you've started doing purchasing from a vendor and you're doing those purchase orders and you're doing those receipts, you start to receive feedback about how many receipts you have from a vendor, what the average lead time is in days, and you can also determine what your planning lead time is per vendor. So if this is a vendor who's in China versus a vendor who's in Wisconsin, then your planning lead times are going to be different. And so choosing the vendor that you're going to do your purchasing from and what their planning lead time is and where they are is a huge impact on the supply chain. The purchase advice is a report. It doesn't actually assist you in generating any purchase orders, but it can give you an opportunity to look at if you want to manually determine what your purchase orders should be. And a lot of people still want to do that because there is a lot to be said for, intimate knowledge of the inventory. You've usually got a warehouse manager who can look at stock and just know immediately what needs to happen. They've been doing this job for so long, they can look at something, they see the pallets are low, and they know where it comes from, how long it takes to restock it, and they can just walk through the checklist and they can do this mentally. However, that's not safest for your organization. And so there's a purchase advice report. What a warehouse manager can't see when he walks through are what you've promised, right? If you've promised some of that inventory to go out the door tomorrow or next week, and he only does his walkthrough once a week, then you start to run into some complications and some shortages there. So the purchase advice report, if you're still wanting to do that manually, can be printed. You can sort it by item, by site, vendor, etc. However it is that you do your purchasing, and it will calculate those suggested quantities for you using those up to or the order point quantities. And again, it goes back and it looks at the transactions. It looks at what you've set up in your item resource planning, and prints out a report that you can then walk out to the warehouse and you can verify for sure what it is that you've got on hand and what you think you need to order prior to doing your purchase orders. The PO generator, however, it takes that purchase advice to another level. And when you can run the PO generator by item, by site, or by vendor, or any combination of those based on how you do your purchasing. And you can then say what your purchase order date is. So you can have the system to look out to a specific date. If you wanted to look out to June 30th, to make your PO is going to be on June 30th. So based on what I have on order, um, um, allocated, on hand, those types of things, what are my lead times, it's going to determine what purchase orders should I send out on June 30th. And you just put in all of the relevant information for your purchase order based on your business, and it pulls up a screen for you. These are your suggested purchase orders to preview. Presumably you have more than one. I have just one. So it will show you the items that it suggests that you make a purchase of. It will propose a vendor if you have one, units of measure, what the order quantity is, and you don't have to generate purchase orders, and you can also edit this. So if I were going to look here at this AT&T phone, I could determine what vendor I'm going to use, and I can change the order. If I just know something, again, there's that intimate knowledge of the warehouse. If I just know something about my business, it makes me say, no, we don't really need 20. I know this is suggesting 20, but I already know we have that big project coming. We need to order 50. You can change your item to 50 and you just work your way down the list here. You can change sites and you just check mark the ones that you want. If there's anything on the purchase advice report that you do not want to purchase, you just don't check it off. So I check off what I want, I make my edits, and then I tell it to generate my purchase orders. So then those purchase orders go and get created. Hopefully, you're using the word templates, and then you can email those out to the vendors, which is going to expedite your purchase process. And then lastly, I want to cover a couple of items on inventory reconciliation with you. Um, the year end came through. We did a lot of work on inventory reconciliations with clients this year, and to help you get ready for next year, and I will be here to help you, but I want to help you get yourself ready for that. I want to talk about the reconcile to GL process, the HITB and the HSS, and maybe help you tee up some things that you can do now or during your slow months prior to the year end, and getting everything ready so that that year-end reconciliation goes more smoothly for you. One thing that some people are not aware of is that there is a reconcile to GL process for the inventory module. And I see people use that for purchasing as well as for accounts receivable, but not very often for the inventory module. And it's a tool under routines and financial. I'm going to try to pull it up here for you to my screen. I can't. Okay, so it's a reconciliation. You select which module you want to reconcile to the general ledger. You can select to do payables, receivables, bank, or inventory. And if you select to do the inventory, then what it's going to produce for you is that you're going to specify what your inventory accounts are, and it's going to produce a spreadsheet for you where you can see what's at your general ledger and what's in your subledger, and it will identify for you transactions that it cannot match. So it'll show you transactions that are on your general ledger that are affecting your inventory accounts, but that did not originate from the subledgers, from inventory, from sales, manufacturing. And by the same token, it will show you what's in your subledger that has not made its way to your general ledger. And it doesn't do the reconciliation for you. It does not post any transactions for you, but it does help you to identify transactions that may be potential problems. And if you're not familiar with the reconcile to the GL, then reach out to myself or Candace or Diane or anyone else on the GP team, and we'll show you where that is at, and we can demonstrate for you how to use it. So the HITB has been a big pain point for a lot of customers this year. Um, and we have customers who have used the historical stock status and who should be using the HITB. And we've had customers who have the HITB, but they haven't been able to reconcile it. So I want you to be familiar, first of all, that there is an HITB reset tool that you can use. If you have the HITB and it's not working for you, sometimes and we have a lot of customers who have been on GP prior to the release of the HITB. And if that is the case, then that HITB reset tool needs to be run. And what it does is it goes through from a point in time and recalculates your inventory for you and brings it all up to date. And it looks at every transaction to determine what your inventory balance should be between your general ledger and your subledger. That HITB reset does a reconciliation. It demonstrates for you any errors that you have in the SQL tables that need to be corrected for your inventory. And then it produces some GL transactions that, unlike the reconcile to GL, the HITB reset does produce some transactions to bring your subledger and your general ledger into balance. The reason that you should be using that HITB is really because of the way that it calculates values as well as what values it tracks. So the HITB, when you put a date in, if you put in the date June 30th, if today is July 4th and you put in June 30th, what it does, it goes to the beginning of time and it calculates everything forward to June 30th to determine what your inventory value is. And it looks at all transactions, including cost adjustments. So if you go use those tools that I showed to you earlier, where you would go in via the change of cost layers and use that, or if you use any of the tools that I showed you to update your standard cost, the HITV takes those changes into account. And so it comes forward and it's a more accurate depiction of the value of your inventory, and it's better for reconciling to your general ledger. However, we have customers who have a very high volume of inventory and inventory transactions. So if you choose to run that inventory reset tool, a couple of things that we've had to do for customers this year when we were doing that. Number one, we may find that we have to move items to historical databases, and we've done that recently, or we may have to run those processes over a weekend. The HITB reset can take anywhere from 12 hours to 3 days. So it's generally done in a test first because you need to get a time test to determine and plan when it will be done. And then you determine whether or not you need to move items to history or if you just need to do it over a weekend, whatever best suits your business. The other report that a lot of people use is the historical stock status, or the HSS report. Generally, if we see somebody using that HSS report, that is a customer who's been on GP since before the HITB. And the problem with the historical stock status is, if I was using that HITB and I ran it from July 4th for June 30th, it went to the beginning of time and added everything up. Well, what the HSS does is it says, okay, today is July 4th, and it backs everything out to June 30th. And so if everything was wrong on June 3rd or on June 30th, and all you did was back out July, it's still not right, right? It hasn't been recalculated. It's just backed out anything new. And so if you had any errors in your inventory, it's all out there still. The HSS also does not track cost adjustments. So again, if you're doing those transactions to adjust your standard or current costs and you're doing it appropriately through the GP user interface, the historical stock status does not track those types of transactions. So they are not included. So it doesn't really have an accurate cost depiction. And there can be a difference between your subledger reported on the HSS and your general ledger reported on the HSS. So it has its uses um, for checking on stock, but for purposes of reconciling to the general ledger, you definitely want to try to get the HITB working. Okay. And that is the end of my presentation. So it is 11:15. I have plenty of time to take questions if there's anybody who has anything that you'd like me to cover again or to cover in more depth.
Yeah, this is Mike Grontowski at Turnkey. If you have any questions right now for Mona, if you could just type them in chat and we'll answer as many as we can in the time permitted. Well, you did such a great job. Everybody's
I'm
speechless.
so I'm looking at the list of customers. I'm about to start picking on people. Annie, Dan didn't join us.
Well, we're going to be we're recording this session and we have it on our website, so don't do that, please.
Annie
Well,
asked a
I
question.
will stand by, and if anyone has questions, I'll be here.
Oh, first
Annie
question from
asked, can you show the inventory reconciliation to GL?
Yes, let me do that. I will reduce this and bring that over here. Okay, can you see this?
I can see it.
Okay, so the reconciliation to the GL is under, I believe it's the routines, right here. And I've not done a reconciliation here in Fabricam. I hope that's large enough for you all to see it. But the module is right here. You can select to do the payables, receivables, or inventory, and you can select your date range. You would need to enter the accounts that are appropriate for your business and choose the output file because it's going to produce an Excel spreadsheet. And so when you select your inventory and then you select some, I'll just select an inventory account here, see if I can get something to pop up for us. Let's do this one. Okay. And
Annie would like to know how often you can run it.
you can run this as often as you want. And it will present a spreadsheet that looks a little bit like this, and it can be a little mind-boggling at first, but you get accustomed to looking at it. And I'm sorry, I am on my cloud PC, so I don't, hopefully that doesn't pop up too many more times. So here's the account that I'm balancing is going to, give you your beginning balance totals. It would show you unmatched transactions right here. So what you would see on the left in these columns, if there were any, you would see any transactions that originated in my subledger that did not, the system was not able to match to the general ledger. And on the right, you would see general ledger transactions in these fields here that did not originate. They affected the inventory count, but they did not originate in the inventory subledger. And then you've got potentially unmatched transactions, and then it will show you all of the transactions that did match. Usually see people use this for AP, but I think Annie, in your case specifically, I think it could be very helpful for you if you ran that for inventory. You can run it for a date range. If you want to look at everything from January 1 to May 30th, or if you want to look at just a much smaller period of time, you can do that as well. You can run it for multiple accounts if need be, or you can just run it one account at a time, depending on how you're reporting your, if you're reporting your inventory to multiple transactions, a lot of people are because you might have site-specific GLs, then you would probably see a lot of unmatched transactions in the, so in that case, you might want to include all of the site level GL accounts.
Hey, Mona. Melinda would like to know, can inventory reconciliation be used for a bookstore? Not selling items to vendors, but issuing books to students.
That's interesting. So if you're, I would need to know, Melinda, if you want to contact me more about how you're tracking that, their inventory items, but how you're releasing those and how you're renting them. Because if you're not selling them and you're issuing them to students in any way other than through the purchases or sales modules, then that reconciliation might not work for you. I would just need to know how you're handing those out and how you're tracking them.
Yeah, Melinda said she'd reach out to you directly.
Okay.
Any other questions? Well, Mona, is there anything else you want to show us?
Well, that's what I was just thinking about. Let me look in the card maintenance and see if there's anything else that I didn't fit here.
Because Tom, this session goes to 11:30, correct?
Mm-hmm. It does.
Yes. And then Ian McQuaid will be on right after.
Trying to look to see if there's anything we've covered recently here that maybe be useful. One thing to talk about, just as just bonus information here, Candace and I have both run into this a number of times over the years with our customers. I'm sure that Diane and Deb have as well. Is there's a logic to the inventory and how it flows. So, the inventory is allocated or received through purchasing or sales order, correct? So, um, so Annie, on your question there, the clients use standard cost or current cost year round based on their business model. The large majority of purchasing and selling inventory are using current cost, but it's typically manufacturing industries or industries where there's a pretty standard cost across the industry that are using the standard cost. So it's so during the year-end closing, they would use whatever they used throughout the year. Um, so when you're consuming inventory at the sales level and then you post that transaction, that invoice, it pushes the invoice through to accounts receivable so you can get paid, and it depletes inventory in the inventory module. What we run across a lot is that a customer does a return and there's a multi-step process to doing those returns, because giving a credit at the accounts receivable level does not push that inventory back into inventory on hand. So you your inventory isn't updated if you simply do a credit at the accounts receivable. Um, Also, once that sales order invoice is posted and goes to accounts receivable, then if you do anything up at the accounts receivable level, it doesn't trace it back to the sales order itself. So if you've got a customer return and you need to bring that inventory back in, and you also need to issue a credit memo or reissue that inventory, it's really important that you do returns through the sales order module. And that's what's going to bring your inventory back in. And it'll be that in that way, when you do the return, you can apply that return or that credit. That is, you can apply those and you get a better audit trail. That's something we run into frequently throughout the year.
Any other questions?